Hi, I'm Tim Kelley from Montgomery Investment Management, and welcome to this week's Video Insight. Well, we've seen a change of mood in the equity market recently. After running strongly for much of 2013, the Australian market has gone backwards in recent weeks, and we've seen a steady flow of earnings downgrades, some of which have led to dramatic share price falls. The news recently seems to be dominated by difficulties faced by icons like Qantas and Holden, problems in the manufacturing sector due to a high A dollar, and a feeling that the nation may be moving from a two-speed economy to a one-speed economy, and not in a good way. This has focused investor attention on the risks of investing in equities, and we're often asked what we think might happen next. Unfortunately, we can't tell what the markets might do in the short term, and we don't know anyone who can, so we don't think that's a good place to focus your attention. The macroeconomic outlook is extremely hard to predict, and even if you get the macro right, the market can still move in the opposite direction. We do, however, have a couple of observations that might be useful. Firstly, we know that there's a good relationship between value and long-run investment returns. If you buy when the market is expensive, you tend to do less well than if you buy when the market is cheap or fair value. At the moment, we think the market is a little expensive, but it's not a million miles away from fair value, so in that regard, there's no pressing reason to be out of the market. Secondly, we know that in the long run the market tends to deliver a much better outcome than cash. The market is risky, especially in the short run, but you get a significantly higher return in exchange for that risk. And after adjusting for inflation, that extra return is very important to long-term wealth. As a general rule, if you can take a long-term view, equities are a good investment option. The third thing to remember is that we tend to be our own worst enemy. We want to invest more when the market has been going up, and we want to take money out when the market has been weak. Extensive research has shown that this tendency to follow the herd has a big negative impact on investment returns, and if you can keep emotion out of the investment process, you're likely to do much better. So in summary, try to be consistent in your investment decisions and avoid getting caught up in the changing mood of the markets. It's not easy to do, but it is one of the most important skills an investor can have. That's it for this week. We'll be back with more next week, and in the meantime, you can keep up with our thoughts on Facebook and Twitter.